They pay you 4.5% in a currency which I believe is deteriorating in terms of purchasing power at 7.5% a year. You're losing 3% a year for 10 years, 3% compounded, which means over 10 years, gold likely goes in nominal terms much higher. Or rather, gold holds its real value while the purchasing power of the dollar declines by 75%.
I'm very pleased to be joined once more by Rick Rule, founder of Rule Investment Media and founder of Battle Bank and former CEO of Spot US, well-known investor in the metals and minerals space. Welcome back to the show. Rick, always a pleasure to host you. Thank you for being here with us today. Thank you.
My pleasure, David. I've watched the growth of your channel with some interest. Congratulations. You've done a great job.
Thank you. Thanks to good guests like you that we have a continuously good program. Let's start by talking about today's CPI report. So 2.7% headline CPI inflation, core CPI at 2.9%. The growth of core CPI of 0.3% month over month was in line with economists' expectations, but now there is basically no chance of a Fed cut by July as inflation ticked up for the first time since the beginning of the year. Keep in mind that inflation has been falling ever since January rather, from 3% to 2.4%. I know you've talked to me about this issue and that these government numbers aren't really reflective of real data anyway. But anyway, now these government numbers that weren't really reflective of real data to begin with are now ticking up. And so I guess the question is whether or not government numbers are finally starting to catch up with reality, or whether or not this is a temporary glitch. And the broader question is also why it's been going up. Mainstream media blames tariffs. What do you blame it on?
Well, I blame it on the deterioration of the purchasing power of the U.S. dollar. That I think is the principal culprit. Yes, tariffs have something to do with it, David. Tariffs are taxes. And increased taxes means increased prices. That's the way things work. There's a couple things that I think you need to consider in order to look deeper at that. One, the relative softness in oil and gas prices, despite a cresting of production, tells you that the economy is quite soft. And increasing core cost in a soft economy is a very, very troubling sign. If you have a circumstance where economic activity is slowed due to tariffs or due to whatever else, but core price levels are increasing, that's very, very troubling. That was the specter of the 70s, stagflation, before your time. The second thing is the ongoing discussions that you and I have had about conflating the CPI with inflation. The layman's definition of inflation is the deterioration of the purchasing power of their savings and their salaries relative to the basket of goods and services that they consume. I realize that isn't the academics' definition of inflation, but it is your listeners' definition of inflation. Almost everybody that listens to you has taxes as a component of their cost of living, and the CPI, as an example, doesn't measure taxes. Simple common sense. If any of your listeners take themselves back to 2020 and compare the pricing levels of the basket of goods and services that they consumed in 2020 relative to the prices of the basket of goods and services that they consume today, will tell you that the deterioration of your purchasing power, whether or not you're American or Canadian, is deteriorating much faster than the level measured by the CPI. Look at the price you pay for gasoline, the price you pay for other forms of energy. If you're in the United States, healthcare and health insurance, rents, mortgages, groceries. The price of groceries is a political issue on both sides of the border. This CPI number, while it's used as an index for government services and while it's a widely used market benchmark, has no relation to the underlying rate of inflation as is experienced by your listeners.
So ultimately then, what is the direction of the CPI, and ultimately what is the direction of the dollar if it indeed is a reflection of the deterioration of the purchasing power of the dollar? Will the DXY's weakness continue all throughout the year? Do you have an outlook for us?
I think that the relative deterioration of the U.S. dollar, which is to say relative to other currencies, probably is overdone. I think dollar weakness relative other benchmarks like the Canadian dollar, the euro, the pound sterling is overdone. And I think that probably represents rightful
Yeah.
aversion to our president in other countries. But I think the absolute deterioration in the U.S. dollar continues. That is to say, the prices of goods and services in U.S. dollar terms, I think probably continues to be problematic for Americans and by extension, everybody else.
We've been starting to see stagflation headlines pop up in the last couple of weeks to months as tariffs unfolded. And now with inflation data finally supporting higher inflation, it's back front and center in headlines once more. Stagflation concerns, is that still a concern for 2025? The slowing down of the growth of the economy and the increase in prices simultaneously?
To me, that and negative real interest rates are the principal concerns. When I talk about negative real interest rates, again, I'm not comparing interest rates to the CPI number, but I'm comparing interest rates to the deterioration in the purchasing power of the US dollar. Those are primary concerns of mine.
With gold at $3,300 an ounce, what do you think the gold market is projecting and or signaling?
I think the gold market is projecting and signaling negative real interest rates. It used to be that gold competed directly with the U.S. 10-year and the U.S. 30-year. Let's look at the arithmetic around the U.S. 10-year. They pay you 4.5% in a currency which I believe is deteriorating in terms of purchasing power at 7.5% a year. If you believe the CPI number at 2.9 and you're getting 4.5, not a horrible deal. You're making a 1.6% real yield. If you believe, like I do, the purchasing power of the U.S. dollar is declining by 7.5, if they pay you 4.5 in a currency that's declining by 7.5, you're losing 3% a year for 10 years, 3% compounded, which means that they give you back about 65% of your wealth after 10 years. That's what gold, I think, is beginning to reflect. The first time that we had these discussions, David, some years ago, I think that I pointed out the weaponization of the U.S. dollar, which is to say the weaponization of the SWIFT banking system, the use of the dollar to enforce American public policy goals on other countries, and the fact that other central banks had no choice but to begin to buy gold to shield themselves from U.S. politics. That's still true. There's still foreign central bank buying. But a larger issue now, and the reason that retail people are buying it, is simply that the U.S. dollar, as expressed by U.S. treasuries, are a lousy arithmetic deal. And you're starting to see that reflected in the gold price.
Gold has been on a tear this year, hitting all-time highs, and the outlook remains strong. Today's sponsor, First Mining Gold, is a Canadian gold company with two major development projects in Canada. The most advanced, the Spring Pole Gold Project, is a multi-million-ounce gold development project located in northwestern Ontario, and the Dupaquet Gold Project, another multi-million-ounce gold project, is located in the prolific Abitibi Gold Belt of Quebec. Capable of producing 300,000 ounces of gold per year at very attractive all-in sustaining costs, Spring Pole is in the final stages of the permitting process in Canada. The final environmental assessment document for the project was submitted to the regulators in November 2024, and the company expects major catalysts leading to a final decision in the next 6 to 9 months. The company recently released a very positive news item announcing the signing of a long-term relationship agreement with the key Indigenous community around the project to support its development. Dupaquet, surrounded by some of Canada's largest gold mines, has a strong multi-million-ounce asset base and is in the middle of an extensive drill program to significantly expand the size of the current resource. Recent drill results help support this assertion. The company is led by an experienced management team that has a very strong track record and significant personal investments in the company. The company CEO is Dan Wilton, and the chairman is Keith Neumeyer. You can learn more about the company in the link down below or scan the QR code here. Yes. Well, let's take a look at what happened with gold. Starting with this article here from the World Gold Council. Central bank gold buying picks up in May as of July 2nd. This was an article dated 2 weeks ago. Central banks added a net 20 tons of global gold reserves in May, an uptick from the previous month. Report states that this is a continuation of a trend of global central bank buying that started nearly 4 years ago. Reg, you and I have talked about this trend for quite some time. It is still ongoing. It is still going strong. in fact, stronger than ever. Gold remains a focus for central banks worldwide, with 95% of respondents in the Central Bank Gold Reserve Survey 2025 believing that official gold reserves will continue to increase, up from 81% last year. A record 43% of central bankers also indicated that their own gold reserves would rise over the next 12 months. I believe there's a bigger story here. If I were a sovereign nation and I wanted to diversify away from the dollar due to tariffs and or trade war uncertainty, I have a few options. I could either boost my FX reserves in the form of another currency, or I could buy gold, or I could, buy other hard assets. Countries are choosing to buy gold, perhaps a combination of all of these things. But, ultimately, why is gold their choice in today's macroeconomic environment?
I think that they trust the U.S. government less than they trusted the U.S. government in the period 1982 to 2020. I think, too, for the reasons that we've discussed earlier, the U.S. dollar or the U.S. Treasury is a less good deal than it is. The great unsung reason, of course, is the central bankers' realization that the U.S. dollar is the worst currency in the world, with the sole exception of all of the others. As little as those central bankers trust the U.S., they trust each other less. How many rubles would the Chinese like to acquire? How many? You get my point.
Yeah.
There is no fiat substitute for the U.S. dollar, and there is no fiat substitute for U.S. treasuries. The United States, for all its faults, has the deepest and most liquid treasury market in the world. If somebody diversifies out of the U.S. dollar, they're almost stuck in gold as a default. Our mutual friend Doug Casey described the dollar as an IOU nothing. He described the euro, because there's 17 backers, as a who owes you nothing. And he describes the prospective BRICS currency as a nobody owes you anything. And so one is stuck with the lack of plausible alternatives for a central bank, for a store of value that's simultaneously a medium of exchange, a function that gold has fulfilled for at least 3,000 years.
Well, there seems to be an everything rally going on right now. I mean, I understand that central banks are buying gold, but they're certainly not buying Bitcoin, which is up to new all-time highs. They're certainly not buying the S&P 500 index ETFs, which is up to a new all-time high last week. The NASDAQ, same story. NVIDIA just reached $4 trillion last week, which is the first $4 trillion market cap company in the world, briefly. And this is all happening at a time when the Federal Reserve is not engaged in quantitative easing. They haven't even cut rates yet. What's going on? Why is everything rallying at the same time?
No shortage of private liquidity. There may be a shortage of government solvency. Solvency and liquidity are very different terms. There's an awful lot of private liquidity out there. And I think that increasingly private buyers look particularly at the long bond market and say they have to take some risk to get some higher yields because they're getting killed on their bond portfolios. In the period 1982 to 2022, a period of very strong U.S. dollars and falling interest rates, the long bond market was a good and safe place to be. Since 2022, the long bond market has been a slaughterhouse, and money has been forced out of the 10-year plus maturities, both public and private, and into markets. The S&P 500, again, for all its faults, has continued to generate pretty stable and growing earnings. It's concerning to some, myself as an example, that about 40% of the market cap of the S&P is made up for by 9 stocks. It's more concerning to me that those 9 stocks are in businesses I don't understand, so I can't invest in them. But certainly nobody can complain about the performance, the corporate performance of the companies that make up the S&P or the performance of the S&P. For many people, they regard that as a viable alternative. Particularly, they regard it to a viable alternative to the fixed income market, and particularly there to the fixed income market in the very long term. Remember, too, David, that in the context of the global economy, something now like $900 trillion in investable assets, the market cap of gold, as an example, is irrelevant. The market cap of Bitcoin is irrelevant. They're important assets to us because our audience is interested in them and listens to them. But in terms of the global flow of capital, not so much.
So can one make the same argument to explain why the GDX, the gold miners index, has finally started to outperform gold this year, which was not the same case last year when we spoke around the same time last year? Is this a macro story then? Yes.
Yeah, this market is following a very traditional pattern. Precious metals bull markets are led by the metal. Uh, Secondarily, until a year ago, the buyers of gold were central banks, and they're not buyers of gold stocks, as you pointed out. It makes perfect sense that the price of something that had a bid would go up, and the price of something that didn't wouldn't go up. In a traditional bull market, when the momentum is established by the physical metal, it takes a while for producers' margins to begin to increase. We saw producers' margins really begin to increase in the first quarter of 2024. And that's come to be reflected in the market. Well, first of all, it's come to be reflected in the operating margins and then the market caps of the biggest and the best producers. If you look at the market response as an example of Wheaton Precious or Agnico Eagle or Alamo, some of the high quality gold producers, the increase in gold prices has really fattened their margin, and the consequence of that is that the market has stood up and took notice. If past is prologue, the market now goes from the best of the best to the best of the rest. You go down the quality trail as the bull market progresses, and we're starting to see that just in the last 3 or 4 weeks, I would suggest, even among the juniors. The financing window is wide open. People are rushing to raise money. Some of them will employ that money intelligently. Some won't. Another thing that you see, David, or at least you've seen in prior bull markets, has been valuation arbitrage. As the largest, finest, and most liquid companies attract capital and their trading liquidity and their share prices go up, a valuation gap develops between the best of the best and the best of the rest. That valuation gap is filled one of two ways. Value arbitrageurs, like me, look for better relative value, in the space. If enough of us come into that market, the valuations among the best of the rest come to resemble those among the best of the best, or the companies with higher valuations and a lower cost of capital take over the other ones. You see M&A. One way or another, that gap gets filled.
Is there a valuation gap right now between the seniors and the juniors, you think?
I would say,
is that even a fair comparison to make?
Yeah, I would say there's a substantial valuation gap, and there's another valuation gap between the junior producers and the developers. So, yeah, I mean, you are seeing companies with feasibility studies, unfunded feasibility studies, that are selling at a third of NAV. You are seeing the best of the best, in particular the royalty and streamers, the best of the best, selling at 1.8 or 2 times NAV. So the valuation gap through the potential developers goes from 2 times NAV to 30% of NAV. Those are pretty substantial gaps.
Are you suggesting that? Wait, sorry. Are these valuation gaps, these discounts to NAV, are they still happening even after the GDXJ has climbed 50% year to date?
Absolutely.
Okay, and so it's not even too late at this point, because one will look at this chart and say, "Well, I missed the rally. Whoops."
I would suggest that to the extent that your audience doesn't believe that gold prices hold this level or go up from here, that they need to be concerned about the market. I personally believe that the purchasing power of the US dollar continues to deteriorate.
Yes.
And so I continue to believe that the nominal gold price increases. If your audience holds a different view, then these stocks are coming to be fully priced, even at today's gold price. But if you don't believe in a deterioration of the gold price, then I think there's a lot of room left in the gold stocks. I should also say one other thing, David. People who listened to you and I have a discussion 2.5 or 3 years ago, when I discussed the best juniors of being in effect riskless because they were so broadly hated, that trade's over. The hate trade. The hate trade's over. If you bought them not on a valuation basis, but simply because they were hated on a contrarian basis, you need to take some money off the table. I've done that very recently myself in the uranium trade. I bought a bunch of uranium juniors to add to a bunch I already owned about 6 months ago because they were so broadly hated. I added, probably 25% of my junior uranium portfolio was acquired 6 months ago. I sold that when the hate dissipated. I wasn't making a trade on a valuation basis. I was making it because my original trade was based on hate, and the hate is dissipated. With regards to the juniors, the better gold juniors, the hate is dissipated too. So people who owned them for a contrarian trade didn't own them on a value or relative value basis might want to take the money.
Right. So now I think what you're saying is it's a little bit harder to find value now than a few years ago when everything was hated. Now you just have to pick quality. Is that a fair assessment to make?
Absolutely. And you need to have a visit with yourself on the premise. My premise is that the purchasing power of the US dollar declines by 75% over the next 10 years. It wouldn't surprise me then to see the nominal price of gold reflect the decline in the purchasing power of the US dollar. In other words, I think over 10 years, gold likely goes in nominal terms much higher, or rather, gold holds its real value while the purchasing power of the dollar declines by 75%.
Let me just outline the arithmetic for people. If the dollar depreciates by 75%, assuming the same purchasing power is maintained with real goods, so does that mean that inflation is also going to go up 75% over the next 10 years for domestic products?
For me, the definitions are the same.
Yeah.
So, yes, I think we have a circumstance that resembles very much the decade of the 1970s, where, according to the Congressional Budget Office, the US dollar lost 75% of its purchasing power. Stated differently, we had several years where the official inflation rate in the United States was in double digits, compounded. Yeah. I think then it's no surprise that the gold price rose 30-fold. I'm not suggesting, by the way, that the gold price is going to rise 30-fold this time, because the gold price has already risen substantially. I am suggesting, however, that it makes arithmetic sense to me that the increase in the nominal gold price will mirror the decrease in purchasing power of the US dollar.
I like you to please just give us a brief history lesson, if you may be so kind, Rick, for those of us who may not have been in the gold market and resource market as long as you. This really is a historic time that we're living in, because you and I, we do this day to day, and so it's like looking in the mirror. We don't really see the changes happening. We don't feel it every day, but if you just zoom out, it is substantial. Just under a year ago, or just over a year ago, in February 2024, if I had spoken to you about a year and 5 months ago, the gold price was just trading at over $2,000. We're up more than 60% in just over 16 months. Now, that's not really what I'm trying to ask here. What is going on in the last 5 years? What is happening this bull market that may or may not be the same as the prior 2 or 3 substantial bull markets? Keep in mind there was the COVID run-up of all asset classes in 2020 when the Fed printed unlimited money, although gold was kind of already moving before the pandemic. There was a multi-year, decade-long bull run that started from the early 2000s to culminating in 2011. And then, of course, in mid-1970s, that's when Nixon took the dollar off the gold standard, and gold was allowed to free float. And that's what happened until the late 70s. Each bull market was characterized by a different macro backdrop and a different reason for the bull rally. What's different this time?
Well, in a sense, between now and the 1970s, not much. I think, by the way, it would be useful for your audience if they looked at that chart and understood that this is a nominal dollar chart, not a real dollar chart.
Yes.
If you simultaneously adjust the part for the declining purchasing power of the US dollar, the chart looks much, much, much less dramatic. But I also think that 2 things happened to characterize this bull market. One was an own goal. a self-inflicted wound by the U.S. government on the U.S. dollar, making it difficult for our trading partners and others to continue to use it as a reserve currency. Whether or not you agree, as an example, with Russia's actions in the Ukraine, the United States government stole $300 billion worth of Russian treasuries. Not something that endears itself to governments that might find themselves with the prospect of imposing policies that weren't acceptable to the Americans. And then the weaponization of the SWIFT banking system, which is not a U.S. controlled asset, to use the dollar to impose U.S. policies on other countries. It is impossible to overstate the importance, I think, of the U.S. government's own actions reducing the strength of the U.S. dollar. I think that really kicked off the rally. The second factor was the realization in the United States and in other countries that the balance sheet of the debtor, the U.S. government and the U.S. society, is much less good than it was in 1982. In 1982, the on-balance sheet obligations of the U.S. government, which is a different way of saying the money that we owed bondholders net, was about 32% of U.S. GDP. The corresponding figure today in 2025 is that we owe 130% of GDP to bondholders. The number is fourfold higher. In 1982, the off-balance sheet liabilities of the U.S. government, which is to say the accumulated unfunded promises for Medicare, Medicaid, Social Security, federal government pensions, and military pensions, was about one times, GDP. The corresponding number today is about 3.5 times GDP. When people look at the relative strength of the U.S. economy and the U.S. government, the underpinning of the value proposition in the U.S. dollar, what they see is a balance sheet that has deteriorated markedly over 40 years, and one where there does not seem to be the political discipline to control the problem. Those numbers, a $30 trillion net obligation to bondholders, and a $100 trillion net obligation to entitlement beneficiaries, are growing at about combined on balance sheet and off balance sheet $4 trillion a year. To put that in perspective, the gross income of the U.S. government before they pay any money for anything is about $5 trillion. Our on and off balance sheet obligations are growing at $4 trillion a year, while our aggregate revenues are only $5 trillion a year. That chart becomes easier to understand when you observe the math behind it.
Let's skip now to more recent history. Thank you for that. I will show you something that happened more recently. Silver has diverged from gold, a pattern that doesn't always happen, but it is happening now. In the past 1 month, silver is up 4% while gold is down 3%. In the past 3 months, silver is up 17% while gold is up only 4%. Historically, when gold goes up, silver goes up more, and the beta extends to the downside as well. But something happened as of June 25th. Something caused these two metals to diverge and silver to strengthen even while gold remains consolidating. Was there an event where it was just a matter of time before it played catch up, and that's what it's doing now?
If past this prologue, it was a matter of time. Whether or not this is an actual breakout or a perturbation in markets, time will tell. But it is a feature of precious metals bull market that the bull market is led by gold, physical gold. When the momentum established by gold validates the precious metals narrative to the generalist investor, and the generalist investor comes into the precious metals space, leadership changes from gold to silver. I don't know why. My suspicion is because of the lower unit price of silver. All I know is that the three prior precious metals bull markets that I've lived through, have all seen at some point in time leadership change from gold to silver.
Let's take a look now at copper. Now, this is interesting. Does it always happen that the three metals move more or less in tandem, except for this massive move in the copper price? That was Trump's tariffs on copper, 50% tariff on copper. That was announced earlier in late June. But beside that, the trend was more or less in place, for the exception of silver running up. These three metals have moved more or less together. Again, coincidence?
I think partly a coincidence. I think they move for different reasons. With regards to copper, the ultimate move is going to take place because I see demand continuing to increase. Remember that 1 billion people on Earth have no access to primary electricity, as an example. And we have invested in copper for 30 years. So I think that the supply and demand fundamentals in copper will have less to do with the investment outlook and more to do with the fact that we're using more of it than we produce. Remember that almost all the gold that's ever been mined is still supply. So you don't have the supply and demand issue. You just have a demand issue. Silver is somewhere in the middle. So I suspect there's a lot less correlation between these metals than people understand. Understand too that the real strength, the strength that you see in the copper price is, as you suggest, at least partly political. It's my belief that the malaise you're seeing in some other industrial materials prices, nickel and zinc as examples, and the flatlining prices that you see in oil and gas, despite cresting production, suggest that in the very near term, the economy is softer than people think. And this may work a little bit of negative magic on the copper market in the months ahead.
Besides gold and silver, which we've talked about, are there any base metals or industrial metals that I guess would resonate with a longer term 5 to 10 year investment theme going forward, meaning something that is critical to the industrialization of the world over the next 10 years that you would put your money in?
If you believe that Mr. Carney is less hostile to Canada than Trudeau was, you likely put your money in Canadian oil and gas. The U.S. oil and gas complex is probably selling for half what it's worth, really, because the net present value calculations applied to oil and gas cash flows are very, very, very conservative on a historic basis. And the Canadian industry is priced at probably half the relative value of its American counterparts, because of the perception in global markets and in Canada that the federal government is hostile to the oil and gas business. If Mr. Carney comes to understand that government revenues from oil and gas are the only way that he can fund his spending plans, and as a consequence of that takes a more pragmatic attitude towards Canadian oil and gas, I think that sector, from an investor's viewpoint, not a speculator's viewpoint, from an investor's viewpoint, is insanely undervalued. Had you asked me a year ago, which I think you did actually, it seemed to me that platinum and palladium were very much oversold. That doesn't seem to be the case anymore. You know, the PGM markets are up 35, 40, 45% in the last 12 months, probably approaching at least near-term equilibrium. But from an investor's viewpoint, not a trader's viewpoint, not a speculator's viewpoint, from an investor's viewpoint, the Canadian oil and gas industry is superbly competitive on a global basis, has a spectacular growth runway, and is really, really undervalued as a consequence of the perception that Canadian society and the Canadian government is anti-energy.
What policy changes concretely would you like to see from the Carney government that would reverse this huge discount in the Canadian oil and gas sector?
I would like to see official sector encouragement for the establishment of transmission infrastructure of Canadian reserves to the East Coast and the West Coast. I would like to see Mr. Carney suggest to President Trump that one rare point of political concurrence that they have is debottlenecking the Keystone Pipeline to enable the export, of Canadian heavy sour crudes to the U.S. Gulf Coast refining industry, which is in desperate need of those crudes. And I would like to see a suggestion both by the Alberta government and the Canadian government that there be some sort of fiscal stability pact. One facet of Canadian history that old guys like me remember that many don't is even the conservative government in Alberta, when the natural gas prices rose, decided to double the natural gas royalty. The industry would like to believe that it's a real partner in Canadian society, and they would like some certainty with regards to the fiscal regime that will lower their cost of capital, at least to the standards enjoyed by their American cousins. I also think that Mr. Carney should acknowledge the past sins of government and suggest that he himself won't pillory the oil and gas industry as he has personally done in the past. That is to say, that he should state that the government would like to be, and Canadian society would like to be reasonable partners of the Canadian oil and gas industry, and that part of the Canadian future, with regards to stable, high paying jobs, includes the industry where Canada enjoys the largest single competitive advantage relative to other countries of any industry in Canada.
Hockey?
Well, if he thinks there's a lot of jobs in hockey, God bless.
Well, let's turn the table now to talk about banking. We'll end it here. Battle Bank, you're the founder of Battle Bank. Give us a timeline of when we can expect to see that that commence.
We've been a long time in organization. The last bank we built took 19 months from preliminary application to approval. This bank was 54 months and counting before we decided to buy a bank, which we've done. We bought a little bank in upstate Wisconsin, actually pretty close to the Canadian border. And now we have a plan to change the business plan of that bank to make use of their national charter and to open Battle Bank. My suspicion is that we're between 40 and 45 days before approval. And my suspicion is that we will open 45 to 75 days from that. So let's be conservative. Let's add 75 to 45 and say I anticipate that we're 130 days away from being open. We're soft opening now. We're checking our procedures with our own money, my own as an example, so that when we open, we don't experiment with yours. But the time is nigh. I'm delighted to say, too, David, thankfully, partly as a consequence of your good efforts and interviews, that the waiting list of people looking to do business with us now exceeds 18,000 people. So when we open, I expect we'll open with a bang. We opened EverBank in the year 2000 with no customer backlog and built that bank over 14 years to 275,000 customers and $28 billion in assets. This bank, we have over 18,000 people that have expressed interest in doing business with us, many of whom having told us what type of business they'd like to do. So we anticipate that we'll have a very, very, very strong open.
Tell us what's different about Battle Bank versus anything else.
A few things. The first is that we'll only have one US dollar savings product. Most banks have 15 or 16. Ours, however, will pay you interest on your checking. If you're interested in interest, do business with Battle Bank, not the guys who don't pay you interest. Secondly, Americans with Battle Bank, like with EverBank, will be able to save in certificates of deposit and money market accounts in 20 different currencies, not just the US dollar. There are periods of time when people's faith in the US dollar has been weakened, this being one of those times. Bank in Canadian dollars, sure. Australian dollars, euro, yen, renminbi, Argentine pesos. Swiss francs. It's all available at Battle Bank. At Battle Bank, your IRA is your IRA. It's not a receptacle for Wall Street's products. Want to own a duplex or a triplex? Want to own a rental vacation home or an Airbnb rental? Want to invest in a franchise? You can do all that with your IRA at Battle Bank. And by the way, we'll make loans for those real estate purchases. Importantly, on the lending side, a couple of credit products that should interest people. Apparently, North American banks don't believe that gold, silver, platinum, and palladium are good collateral, but I do. They're liquid 24/7. We will loan money against your gold, silver, or your platinum and palladium at Battle Bank. whether or not what you want to use some of the capital that you have tied up in that gold to buy more gold or to put a down payment on a duplex. You can access capital that you have tied up in precious metals without having to sell the precious metals. Special deposit products for Canadian public issuers that raise money in Canadian dollars but spend US dollars around the world. Um, we don't intend to be all things to all people, but we intend to serve our market, largely markets made up of people like your listeners, extraordinarily well.
Uh, Two follow-up questions wanted to hear. Number one, the yield curve is expected to steepen, according to some economists I've spoken to. What does this mean for the profitability of banks?
It depends on how the bank is run. One of the big mistakes that banks make is play the yield curve backwards, which is to say they lend long and they borrow short, which means when interest rates rise, they don't have the ability to raise the long rate, but they have to pay more for the deposits that cover it, and their margins get killed. That's what was responsible for the demise of the U.S. savings and loan industry. It's also what was responsible for the demise of banks like the Mercantile Bank of Canada going back in time and Silicon Valley Bank. I've been a banker long enough that I don't lend long and borrow short.
Yeah.
I just don't do that. But many of my competitors, particularly guys that don't have as much of their own money invested in their bank as I do in mine, try to take shortcuts. They try to play chicken with the yield curve. Banking is a very, very, very good basic business if you play the game sort of like Ohio State played football, which is the blocking and tackling. If you do the basics right, if you lend against assets where you understand their value and don't lose money, and if you don't play chicken, Russian roulette, as it were, with the yield curve, we won't do either.
What lessons can a new bank like Battle Bank learn from the collapse of several regional banks exactly 2 years ago, including Silicon Valley?
Well, Silicon Valley Bank was a very good bank had they stuck to their knitting. Silicon Valley Bank took the point of view that the Fed was going to lower interest rates forever, and they could afford very long average durations funded by overnight deposits. They also didn't have a great retail deposit base. Most of their deposit base was in very, very, very large deposits held by technology companies and funds. When the technology companies and the funds looked at the fact that Silicon Valley Bank's average duration was 8 years, and that these weren't floating rate loans, they understood the risk that a run on the bank would have, and everybody sought to be first out the door. The lesson, pretty simply, is that you need to match your deposits with your liabilities. You need floating rate assets. You need a stable deposit base, and you absolutely positively do not play Russian roulette with credit markets.
What assurances can you give to, I guess, customers of Battle Bank that I guess some of these safeguards you've mentioned can be implemented?
24% of the capitalization of the bank is mine. That's the best guarantee I can give. Every bank needs adult supervision. With regards to Battle Bank, you're looking at it. The second largest shareholder of the bank, run by a family office of a former Fed governor, also contributed 24% of the capitalization of the bank. The CEO of the bank, Frank Trotter, has been a banker for 40 years. Um, Unlike what you like, there's no Mr. Royal Bank, okay? Unlike with some of the bigger banks, what you see is real, true adult supervision at this bank from veteran bankers, to be sure.
Okay, good. Well, let's follow up on the Battle Bank story once it does launch. So we'll have you back soon, Rick. Thank you very much for your time today. We appreciate
David,
it.
thank you so much for the opportunity, and once again, congratulations for the great growth of your channel.
I appreciate that. Thank you. Where can we learn from you? Where can we follow you in the meantime?
Best place to find me is my website, ruleinvestmentmedia.com, and I'll make it worth your while. Go to that site, ruleinvestmentmedia.com, list your natural resource stocks, and for no obligation, I'll rank them 1 to 10. Note, I'm just off my own conference, so I'm about 200 rankings behind, so be a little patient. But ruleinvestmentmedia.com, list your natural resource stocks. Please no tech stocks. Please no pot stocks. Please no crypto. I'll rank them. No obligation, no charge.
All right. Thank you very much. We'll put the link down below. Make sure to follow Rick there, and we'll speak to Rick again soon. Thank you for watching. Don't forget to like and subscribe.